Good morning. Thank you for joining us. On behalf of myself and everyone at ETF Portfolio Partners, I'd like to welcome you to our 17th annual Market Outlook meeting. It's hard to believe that we started this back in 2008, which obviously was a very different time for the market, if you remember. In 2008, you had the global financial crisis. You had real estate prices plummeting. The S&P 500 index closed down 35% for the year. Still one of the worst annual losses for the S&P 500 index. So we really thought it was important to get together with our clients and talk to you about our strategy, what we're doing and why we're doing it. We wanted complete transparency so you knew what we were doing in those difficult times, so you would have the confidence to stay with it. Well, here we are today, very different situation. You got the market at an all-time high coming off a 3-year bull market. Portfolios are up, but the message is the same. The strategy doesn't change based on how markets change. It's a consistency that works. Consistency over time is what works in the marketplace. And so today what we want to do is to continue to provide that transparency so you know and understand what we're doing. I appreciate all of you being here. I know it's a beautiful day today. We appreciate the great turnout. Certainly we couldn't do what we do if you didn't allow us to, so thank you for being here, and we hope you enjoy the presentation. We're going to break it up into 4 15-minute segments. I'm going to talk about volatility. Then Courtney is going to talk about the importance of planning. Will is going to talk about those macro factors which drive the stock market in the short, intermediate, and long term. Then Nick is going to come up and talk about the portfolios. As our Chief Investment Officer, he's going to talk about what you own in your portfolios, why you own it. He'll talk about what worked and what hasn't worked. And then he'll talk about what we're seeing as we look forward into the following year. I always like to start just to give you I'd like to start with a quick update. The firm turned 21 this year. Debbie and I started the company in 2004. We reached $425 million in assets under management. So that now ranks us in the top 25% nationally of all RIAs. We couldn't have done it without the trust and confidence of everyone in this room, so thank you. We work with clients in 24 different states. I like to mention that because a lot of times someone will say, I've got a friend or relative in another state, can you work with them? We are a national firm. But by far, the biggest event that happened this year was Courtney and Morgan joined the team. You're going to get a chance to hear from Courtney here in a few minutes, and hopefully you can talk to her afterwards, get a chance to meet her. And Morgan, you probably met as we were checking in. We're excited to have both of them on board, and I think you'll agree with this, they were a good addition to the firm. Before I go to volatility, I want to talk for just a minute about the ETF industry. So when Debbie and I started this firm, there was about $50 billion invested in ETFs. They'd only been around for about 8 or 9 years, relatively new investment vehicle. There were virtually no firms doing ETF-based portfolios. But Debbie and I had an idea that you could use this new investment vehicle and build better portfolios. So when I wrote my book about 25 years ago, I said the following. I said, exchange traded funds are the most important financial innovation of the last 30 years and the catalyst behind a powerful new approach to portfolio management. I went on to describe how we manage your portfolios. Asset allocation, implemented using low-cost ETFs, rebalanced in a very systematic way. Well, today there's over $4 trillion invested using a similar strategy in ETF model portfolios, and there's some $13 trillion in ETFs. So the rest of the country, the rest of the world has embraced ETFs. I continue to feel the way I did then, that it's the most powerful tool to use when building portfolios. And all of you in this room were early innovators. You jumped on board early to the ETF movement. So let's talk about volatility. You may have noticed that the market was volatile this year. You may feel like this: tariffs are on, you're down, tariffs are off, you're up. It's like a roller coaster. You have a good reason for feeling like this. 48 days so far this year, actually add 2 more because of what just happened last 50 days this year, 50 trading days, have had a 2% move from high to low. That's 20% of the days. We could go an entire year with only 2 or 3 days being that volatile. We had a 19% decline from high to low in about 3 weeks when the tariffs went on. We then had a 35% gain from low to high. We also had one of the largest moves in the history of the market, the 8th largest move in the market. We had almost a 10% gain in the S&P 500 index in one day. That's a good return for an entire year. And in fact, it was the 3rd most volatile year in the last 20 years. So you ask, how do we know that? Well, like everything else, Wall Street likes to measure things. Wall Street likes to measure your fear. And they measure your fear with something called the volatility index. The volatility index has been around since 1993, and basically it shows anticipated volatility expectations for 30 days forward. And it basically measures how scared we are as investors. And if you look at it, here's a chart of the volatility index for the last 5 years. On the lower left, it starts in July of 2020, and it runs to July of 2025. The dotted line across the middle of 21 is the average over the 5 years. So think of it this way. Whenever that blue line goes below the average, things are pretty calm. Investors aren't nervous. The market's probably drifting higher. When it goes above that line, there's a little bit of fear. And when it goes dramatically above it, there's a lot of fear. So if you look on the far left, that was coming out of COVID. We were above that line for most of that period for that year, 2020. And we spiked up to 40 a couple times, and in 2021 it dipped below that. And then look what happened in 2022. We all remember inflation, interest rates, worst bond and stock market combined since the 70s. Volatility spiked, but it never really got dramatically high. It just stayed kind of at an uncomfortable level all year long. And then at the end of 2022, it dropped below that dotted line, and it stayed there for 2.5 years. That's your bull market. That's confirmation of the bull market taking place. So we wrote about this a few years ago, that the VIX provided that confirmation. Then we had a spike up in November of 2024. Any guesses what caused that spike? The election. People got nervous. We spiked, came back down, and then President announces tariffs, and we reached the highest point of fear. This is when you turn on TV, and people are telling you, you shouldn't be in the market. It's dangerous, get out. Well, it also was the 3rd highest point in the last 20 years. So that's why you were scared. It was a scary time. Now I'd like to stand up here, and I wish I could tell you it was an aberration. It's not going to happen again. But the fact of the matter is, the stock market has been getting more volatile since the 1950s. So if you look at the standard deviation of daily prices in the marketplace, what you'll find is in the 1950s, that number was about 0.65. Today it's 1.33. The daily volatility of the stock market has doubled since the 1950s. Why is that? Well, part of it is technology, right? You can push a button and trade $1 billion worth of stocks like that. You've got these high-frequency traders who are trading in milliseconds. You've got market concentration. A small number of stocks now are a huge portion of the overall market, which causes more volatility. You've got instant access to information like we've never had. Right? Everyone in this room remembers a time when if something happened on the east or west coast, you may not know about it until that night on the local news, or you read the paper the next day. Now you can sit at your computer and monitor a typhoon on the other side of the world and do trades based on disruptions to the supply chain. Don't get me wrong, price discovery is good, having all the information available, but it creates more volatility. And then finally, investor behavior. Years ago, in the 60s, the average investor held a stock for 8 years. Any guess how long the average investor holds shares of an individual stock now? It's less than 6 months. People have their phones, they treat the stock market like a casino, and it impacts all of us. So volatility is not going to go away. It's here to stay. So what do? There are really 4 ways to manage volatility. There are actually 5. The 5th would be just don't invest, but that's not an option. One is diversification. Nick's going to be covering that when he talks. The second is to have a systematic rebalancing strategy, which we've talked about quite a bit in these meetings, so we're not going to cover it here. The third is use an index-based fund like an ETF. That's why ETFs have grown in popularity. They're going to reduce the volatility as opposed to owning an individual stock or an actively managed fund. And then finally, what I'm going to talk about is time horizon. A lot of people don't think about time being your most important way to manage volatility, but it is. As your time horizon increases, two very powerful things take place. Your probability of losing in the stock market goes down, and your range of returns become more narrow, more predictable. Those are both good things. A lot of people counterintuitively think, oh, the longer I'm in the market, the greater chance of losing a big chunk of money. It's actually the exact opposite. If we look at this chart, along the bottom you see different holding periods. 1 day, 6 months, 1 year, 20 years. And on the left, the percentages are the probabilities that your investment will be higher at the end of the holding period than at the beginning of the holding period. And this goes back to 1950, so it covers 75 years. If you hold the S&P 500 for 1 day, pick any day since 1950, you've got a 51% probability of making money. But if you decide I'm going to hold it for 1 year, your probability of making money goes up to 74%. All you did was extend your holding period and you reduced the chance of losing money. If you extend it to 20 years, which most people in this room have 20-year time horizons, if you extend it to 20 years, there were 0 20-year rolling periods since 1950 where you would have lost money. So again, we think about the market as being a dangerous thing to be in. It becomes less dangerous the longer you're invested. The second thing that's amazing about time is that the longer you're in the market, the more predictable your returns become. Let's go with the 60-40 portfolio. This is one of the most commonly held portfolios. A lot of you have portfolios which are 60% stocks, 40% bonds. If we look at 1-year return since 1953, we find that there was a 1-year return where that portfolio was down almost 15%. There was also a 1-year return where it was up 33%. Obviously, that's a wide swing. You can't do any planning based on that. If you sat down with us and we said, oh, you may make 15 or 33%, you may lose 15, we can't make a plan with that. But look what happens if you extend your time horizon to 5 years. You now say, I'm going to be in that portfolio for 5 years. The range of returns have gotten closer. And so now, your worst case was a 5-year period where you averaged 1% per year. The best was you averaged 21%. If we extended another 5 years to 10 years, the returns get narrower. So now a 10-year time period, the return is 2% all the way up to 16. Why is this important? When we sit down with all of you and we talk about planning, we talk about what kind of average return can we get. If we continue this and go out 20, 30 years, you'll find that the upper limit and lower limit will get closer until they get to that average return. This is how we can have confidence saying, if you're in retirement and you need to pull 4% per year out of your portfolio, and you're in a 60-40 portfolio, and you're going to leave it for 20 years, you should never have to worry about running out of money because that average return will be above 4%. It doesn't mean you won't have a year where you're down 15%, because you will, but what we're looking at is a long term. So, the message today from me is volatility is here to stay. Maybe not as bad as we saw this year, but it's here to stay. You need a strategy that will cover the strategy and take care of it, but you also need to have the right time horizon. And I'm going to close with this. In this industry, a lot of people use risk and volatility as if they're the same. They're not. There's a big distinction between the two. Risk is the permanent loss of capital. Risk is you buying a stock, you buy Enron, it goes down, it goes out of business. You can hold that stock for the next 50 years and it's never coming back. Volatility is the temporary don't know if that temporary period is 6 months like it was this year, where we were in February we lose 19%, then we run back up and get it back. Maybe it's 3 years, maybe it's 5 years. We deal with volatility, which is temporary loss of money. The only way volatility becomes risk is if you sell when your portfolio is down and you lock in that loss. So that's why you've got to have the portfolio aligned with your time horizon, and that's what we work incredibly hard to do. So with that, I'm going to introduce Courtney Hicks, who's going to come up and talk about some planning issues. She joined us almost a year ago now. Courtney's a graduate of the University of Kansas with a degree in finance. She's a licensed registered investment advisor. She's become a key part of our team. We work on everything together as a team, and I think as you get to know Courtney and work with her, you're going to find out that she's very intelligent and she knows her stuff. So with that, let me welcome Courtney to talk for a few minutes.
Then I realized that I was not going to be the next Simone Biles. So I decided to quit gymnastics and go into all the sports that I never had time to play. And that led me to basketball. My dad was pretty pumped about this transition. He loved the game and he always coached my brother in basketball. And now this was an opportunity for him to coach me. But I really didn't know anything about basketball besides the fact that I wanted to play. So as we're getting ready for the first practice, I was sitting there and I asked him, can I just play defense? I really just want to play defense. And he looked at me and he tried not to laugh. And he was like, Courtney, you can't just play defense. I don't have enough timeouts to call to bring you in and out of the game whenever we turn over the ball. And he's right. I quickly had to learn how to play offense. And looking back now, asking just to play defense seemed kind of ridiculous, right? Well, many people think of retirement planning as a game of offense and defense. During their working years, they think of offense, earning, saving, accumulating assets, without fully thinking ahead. Then when retirement arrives, they try to call a timeout, pause, and switch to defense, focusing on protecting what they've built through tax, estate, and risk management planning. But true financial success isn't about switching from one mode to the other. It's about playing both offense and defense throughout your entire life. And that's the foundation of this four-bucket approach that we see here. The grow, give, live, and protect. The grow bucket focuses on building your wealth through investment, saving, and compounding returns. The goal is to ensure that your money continues to work for you, not just before retirement, not as you approach retirement, but during your retirement. The protect bucket safeguards what you built. It's not just about preserving your wealth later, it's about protecting your ability to build wealth now. Early protection helps prevent financial setbacks from becoming permanent obstacles. And then we get into the give bucket. The give bucket represents your legacy, the impact you will make. This isn't just about transferring wealth after death, but it's also about giving during your lifetime, to align your money with your values and your purpose. And then most importantly, the live bucket. The live bucket reminds us to enjoy what we've worked so hard to build. This includes experiences, travel, hobbies, whatever you envision for yourself in retirement. One of the biggest misconceptions about financial planning, especially in retirement, is that you should stop spending and focus solely on preservation. The live bucket reinforces that money is a tool for living in, not just a number to protect. So why are these four buckets more important now than ever? Well, whether you realize it or not, we are in the midst of the great wealth transfer. Never before in history has so much money been passed from one generation to the next. And as you can see in the chart here, the trillions of dollars that each generation is about to inherit. For those of you in that baby blue box, the baby boomers, unfortunately your time of receiving has almost come to an end, and you're going to switch to giving. This is exactly where the four-bucket approach becomes essential. Give, live, grow, protect. Without a plan, families risk losing significant wealth. And to really understand the stakes, you have to look at where the majority of the money is being held. So as of quarter 2, 2025, $18 trillion are being held in traditional IRAs. $13 trillion are being held in 401ks, and $14.8 trillion are being held in other pre-tax retirement accounts. That's a grand total of $46 trillion. It's a lot of money. It's almost as much as the entire U.S. housing market that currently sits at $55 trillion. But the key word to focus on here is pre-tax. All of this money is in pre-tax retirement accounts. And as Benjamin Franklin says best, nothing can be said to be certain except death and taxes. And that's where we get this RMD tax law. RMD stands for Required Minimum Distributions. It's essentially the IRS saying you defer taxes long enough, now it's time to pay up. So starting at age 73, or 75 for those of you born after 1960, the government requires you to withdraw a minimum amount each year from your pre-tax retirement accounts. Those withdrawals are then taxed as ordinary income, just like your paycheck was during the working years. The problem is, after decades of growth, these accounts balances have become quite large, meaning the required distributions that you'll have to take will be quite large too. And when those distributions are added to your other retirement income, they can push you into a higher tax bracket, increase your Medicare premiums, and affect how much of your Social Security is being taxed. So while RMDs are designed to ensure that taxes are eventually paid on this money, without planning, it can unintentionally create a tax ripple effect, leading to higher overall taxes in retirement than you ever expected to be in. Don't worry, you're not powerless in this situation. That's where tax-efficient planning comes into play. So let's start with an example. John is currently 67 with $2 million in a traditional IRA. That money grows tax deferred at about 7% per year. Once he turns 73, he'll start taking withdrawals, those required minimum distributions, and pay taxes on the amount that he withdraws. Doesn't sound bad, right? But when we put this into perspective, at age 73, John will have to withdraw $75,427. At age 78, $105,000. At age 83, $144,000. And at age 88, $193,444. Each year, the required minimum distribution increases, and so do your taxes, even if you don't need that income to live on. That's why the RMDs can become what we call this RMD tax bomb. The bigger your account gets, the bigger the RMD, the bigger the tax bill. The key here is planning ahead, using strategies like Roth conversion, gifting, and charitable giving to spread out and manage the tax impact before RMDs kick in. So let's start with Roth conversions. So what is a Roth conversion? Roth conversion is where you take that tax sheltered account and you move it into a Roth IRA. You pay taxes on it now, once, and then you enjoy tax-free growth and tax-free withdrawals. It's great for your heirs as well, as they receive this money tax-free. So when's the best time to do a Roth conversion? That's where the golden window comes into play. Here you are looking at how your federal tax bracket changes as your taxable income increases. That's where we get the golden window. It's that period between retirement, starting Social Security, and taking your RMDs. The golden window provides a few years to do Roth conversions because your income is lower, meaning that your tax impact is lower. And as we know, the lower we get that pre-tax account, the lower the RMDs, the lower the tax bill. Roth conversions aren't the only tax-efficient way of planning. We can get into gifting. So let's start with general gifting. You can give a set amount per year to any number of people without filing a gift tax return. For 2025, that number is $19,000 per person or $38,000 for a married couple. Again, no limit on the number of recipients you're gifting to. These gifts can include cash, securities, or other property. Now, if you exceed that annual exclusion, you have to file a gift tax return. But here's where a lot of people get confused. Just because you file a gift tax return does not mean that you owe gift taxes. Anytime you give more than the annual exclusion to a single person, you have to file a gift tax return so that the IRS can keep track of how much of your lifetime exemption you've used. That lifetime exemption for 2025 is $13.99 million for a single individual and $27.98 for a married couple. Good news is that number is expected to increase in 2026. But again, you don't actually have to pay gift tax until your total lifetime gifts go over that lifetime exemption. So for most people, it's just a paperwork item, not a tax bill. Now let's get into qualified transfers. Qualified transfers are payments that you make directly to an educational or medical institution on behalf of somebody else. The benefit to qualified transfers is that they do not count towards your annual exclusion or your lifetime exemption that we just talked about. And then immediately they lower your taxable estate. So if you're helping grandkids with college or covering medical bills for family members, this is a fantastic way to do so. And lastly, we'll hit on qualified charitable contributions, otherwise known as QCDs. So starting at age 70 and a half, you can give up to $108,000 per year per person directly from your IRA to a charity of your choice. This gift counts towards your RMD, and you do not have to pay tax on the amount that you give. So if you're above 70 and a half, and you regularly give to a church or charity, we highly recommend you do this through a QCD to lower your taxable estate for the year. Now, all of these tax-efficient strategies are important, but they have very little impact on your portfolio if you do not save the market. At the end of the day, your investments are the engine that drive your success and what drive your wealth. So let's look at the market psychology. As Rich mentioned, compounding works best over years, not months. Missing even a few days of the market's best days can dramatically reduce your overall returns. What we know is that the market values time, not timing the market. 90% of investors base their investment decisions on emotions rather than logic and reason. It's kind of scary. Those top two emotions are fear and greed. Greed leads us to buying high, and fear leads us to selling low. And that's tied directly to investor emotions. Fear makes us sell during downturns, while greed can push us to buy at market peaks. Historically, investors who stay fully invested earn 2 to 3 times higher returns than those who try to time the market. Of course, the market is volatile. There will always be day-to-day or year-to-year fluctuations. But the key lesson here is that volatility does not equal loss, but pulling out of the market during volatility does equal loss. What we also know is that markets historically recover over time from downturns and often reach new heights that follow those downturns. So let's take a look at an example of this. So what this chart shows is what we call confidence shakers. Confidence shakers are what we see in the headlines: wars, recessions, elections, pandemics, and in this year, tariffs. Every year there's something new in the headline that makes investors nervous, and it's natural to panic when things feel uncertain. But it's important, but here's the important part. The market has historically recovered over time and grown despite all these events. The lesson here is clear. Short-term fear does not stop the market from moving forward. Those who react emotionally, like selling during downturns or trying to time the market, often miss out on the best days of the market. On the other hand, investors who stay disciplined and focused on their long-term plan historically see much stronger returns. And the best example of this is Warren Buffett. Warren Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." Buffett's wealth didn't surge until after age 50, as we can see here. He knows that compounding takes time and discipline and patience. The lessons here are clear. Don't chase the quick wins, stick to your plan, and have trust in time and discipline. Now, just like Warren Buffett, many of you are thinking about transferring your wealth. The next big question to ask is, how do you pass it on and make sure that it lasts? That's the importance of a financial plan. As we saw earlier, millennials and Gen Xers are inheriting wealth, a large portion of that wealth, and often for the first time. Without guidance, a financial plan is like handing someone a giant gift card with no instructions. The money's going to disappear pretty quickly. So passing on wealth isn't just about passing on your money to the next generation. It's about equipping the next generation to handle it wisely. And that's where tools like Money Guide Pro comes into play. What you're looking at here is a snapshot of Money Guide Pro, our financial planning software. For those of you, this may look very familiar, and for others, we'd be happy to introduce you to it at any time. Money Guide Pro is a tool that we use to create a personal financial plan focused on your unique goals, what you need, what you want, and what you dream of. so you can make confident, informed decisions about your money. Here's how Money Guide Pro helps. We start with what matters to you most, whether that's retirement, traveling, buying a home, or leaving a legacy. And then we get into the interactive planning and see in real time how different choices and decisions like saving more, retiring earlier, or adjusting spending impact your plan. We test your plan against different scenarios like market drops or unexpected expenses to ensure that it's resilient. And the most important thing to highlight here is that Money Guide Pro considers everything that we've talked about today: taxes, retirement income, and Social Security, to give you and your heirs a realistic view of what your plan is. So as we think of a financial plan, think of it as like the umbrella that you keep in your car. During sunny days, you don't really need it, you kind of feel like it's unnecessary. But when the rain randomly starts to hit, you're really glad that you planned ahead. Your plan won't stop the storm, but it keeps you from getting soaked. And it is the confidence, protection, and peace of mind. And now I will hand it over to Will to cover market drivers.
Hello. For those of you who don't know me, my name is Will, and I've been at the firm for almost 5 years now. In that time, I've had the pleasure to meet and work with many of you here, and I look forward to working with all of you in the years to come. Today, I'm tasked with telling you about what actually drives the stock market, specifically in the short, mid, and long term. So when we look at what drives the stock market, there's a lot of different factors that come into play, but ultimately, it's the supply and demand of stocks. If the demand of stocks goes up, the price has to increase to reflect that increase of demand. I could go into detail about all of these different topics, but for today, I've chosen 3 that I believe have had a pretty big impact this year and will continue to have a big impact in the years to come. Those 3 are, in the short term, the government; in the midterm, the central banks or the Federal Reserve; and finally, in the long term, innovation, specifically artificial intelligence. So starting in the short term, this is a chart of the S&P 500 this year. As Rich covered, we all know that this year was an extremely volatile year. And to try to explain some of that volatility, I've picked out a few dates. The first date is February 4th. This was when the initial announcement of 25% tariffs on Canada and Mexico and 10% tariffs on China was announced. As you can see, after that date, the market started to decline pretty rapidly until we got to March 4th. On March 4th, it was announced that, well, actually, some of those tariffs would be 10%, not the 25%. Market participants were excited about that news because it meant maybe tariffs wouldn't be as bad as they anticipated. Well, that was until we reached April 2nd, aka Liberation Day. Everyone knew that there was going to be some sort of announcement on this day, but nobody was quite prepared for how big of an announcement it was going to be. As you can see, the market sharply declined. As Rich talked about, this was a period that a lot of people were fearful. If you turned on the news, you were hearing experts telling you that these tariffs were going to destroy the global economy. Stocks were really going to continue lower, and you had to get out now unless you wanted to continue losing money. Well, if you would have listened to them, you would have missed out on April 9th. About a week later, the 90-day pause was announced. That's when the S&P rallied for 9.5% in a single day. That's why we always say it's impossible to market time. No one in that week expected the Trump administration to put on a 90-day pause. No one really knew what they were going to do, but no one saw that coming. It's so hard to time the market, and this is a classic example of how some of the best days in the stock market occur after some of the worst. After that, between April and August, there was preliminary trade agreements with 7 different partners, and there was a temporary truce with China until we got to pretty recently, October 10th. It was announced that there was a threat of a 100% tariff on Chinese imports. The market reacted negatively again until it climbed steadily to November 7th, where finally President Trump and Xi Jinping reached an agreement on tariffs. We'll see if that sticks. Now, all of us in this room experienced this volatility during this year. It was pretty much the main culprit was our current administration. That's the government affecting the market in the short term. So why did we have to go through this volatility? We believe that this map might be the reason. What this map shows is the year 2000, and it shows all of the countries in blue that are a larger trading partner with the United States, and then all of the countries in red are a larger trading partner with China than the United States. As you can see, in 2000, the United States was the global dominant trade partner for most countries. How does that same map look 24 years later? It's flipped. Now, the majority of countries in the world are a larger trading partner with China than the United States. We believe that this is one of the main reasons why the Trump administration was so adamant about tariffs this year. Now I'd like to switch and talk about what moves the market in the midterm. In the midterm, specifically the Federal Reserve and the policies that they set can have a large impact on the stock market. But the Fed hasn't always been what it is today. It was founded in 1913, but it wasn't until 1951 that they gained independence. It wasn't until 1979 that it became common thought that the Fed should fight inflation by raising interest rates. In 1994 was when they started to give public policy announcements and Fed speak became a term. But it wasn't even until 2008, with the housing market crash, the Federal Reserve started to implement what is known as quantitative easing, and it's really what has intertwined the Fed and the stock market. So what exactly is quantitative easing? It starts with the Federal Reserve deciding that they need to stimulate the economy because we're either in a recession or we're nearing one. How do they do that? They start to buy government assets from banks. If the Fed is buying, that means banks are receiving money. If the banks now have more money, they start to lend out more. If there's more lending going on in the market, that pushes interest rates lower. And we all know that when interest rates are lower, businesses and people start to spend and invest more money, and that is the ultimate goal, where the spending and more investment leads to an economic recovery. Now, some critics of this strategy might actually tell you that that's not quantitative easing, that's money printing. They say that because it's essentially the Federal Reserve deciding to inject our economy with billions of dollars. Now, whether you agree or disagree that it's good or bad for the long term of our country, it does help us avoid those decades-long recessions that we had in the past. But that's not the only tool that the Fed has. They're usually in the headlines because the Federal Reserve can set interest rates. This chart shows the Fed funds rate going back to 2022. As you can see, they had to aggressively hike rates to fight inflation. It worked, and now inflation is not nearly as bad as what we saw in 2022. They then paused rates for about a year, lowered them a bit, paused, and now they're back to lowering. They most recently lowered in October, and the current range is 3.75 to 4%. That orange line on the right represents the median prediction of experts on where they believe the Fed will be with interest rates in the year to come. As you can see, the majority agree that they're going to continue lowering rates. The Federal Reserve meets again in December, and there's about a 70% chance that they will lower rates again. So we will see. For those of you who don't know who this is Jerome Powell, the current Fed chairman. The Fed chairman is appointed for 4-year terms by the current president of the United States. Jerome Powell's second term is up in May of 2026, so in a few months. And I'm not a political expert. I don't want to try to get in the head of Donald Trump. But if I had to guess, I'd say Jerome Powell's probably done as being the Fed chairman. If you read any of these tweets, you'll see that a common theme is that Trump believes he should have been lowering chart might explain it. What it shows is the last 10 times the Federal Reserve began to lower interest rates, and it shows the number of days that they lowered interest rates for, and then finally it shows the S&P 500 cumulative return during these easing cycles. The average annualized return during these easing cycles was 15.5%, and the median return was 13%. If we compare that to all cycles, you can see that it outperforms all cycles by about 5% on the average. Now that's pretty good, but there is some potential headwinds that could come with this. First, and a pretty important one, is that it could cause an inflation resurgence. We all experienced 2022 and 9% inflation, and none of us want to have to go through that again. Second is it reduces the policy flexibility in the future. If we go through a recession while interest rates are low, it's hard to lower them further in order to stimulate the economy. Third, it sends mixed signals about the economic health of the country. A lot of people kind of agree that the economy is in a pretty good spot. Consumer spending is still high, unemployment's low, the stock market is still in a bull market, so people are kind of wondering why we'd be lowering interest rates a bunch. But I think the most important point is that it has the potential to lead to the loss of Fed credibility. One of the main positives of the Fed is that it is a nonpartisan, independent agency. If the current president puts in a new Fed chairman who just takes his orders and does whatever he wants to do, it will lead to a loss of that credibility, which we'll see the ramifications of in the future. Now, I want to talk about what moves the market in the long term. In the long term, it's simple. Innovation moves the market, specifically the increase in productivity that we get from that new innovation. Well, the new innovation of today is artificial intelligence. When I was looking for what to talk about, I kept seeing a ton of news articles and videos, and I wanted to just play one real quick to talk about AI.
Artificial intelligence is transforming the world we live in. Will the stock market continue to rise with the increase in productivity made possible by AI?
And I'm sorry because I actually just lied to all of you. I didn't find this video, as some of you may have guessed. I created it using AI. That's not a real person. The words she said were ones that I typed. This is just to show you how good the technology is right now, and that it's only going to get better in the future. So what exactly is AI? Well, it's a lot of things, but essentially it's the science of trying to make machines smart. How do we tell if a machine is smart? Well, we see how well it is at mimicking human-like behavior. Can it learn? Can it problem solve? How well does it communicate with people? And ultimately, the goal is that it will lead to an increase in productivity in the future. So what does AI actually look like today? Some of you may be thinking, yeah, that was a cool video, but I don't use AI. I guarantee everyone does. It's in our guidance systems. It helps us find new restaurants, new places. It's working with our healthcare system, helping them diagnose diseases at a faster rate. It's your Face ID on your phone. It's how your phone knows, yeah, that's the person who owns this phone, let them in. And it's the driverless cars that are only going to become more popular. So that's what AI looks like today. What could it look like 10 years from now? Let me introduce all of you to Neo. Neo is being advertised as an AI-enhanced robot that will do common household chores. It's washing your car, doing your laundry, taking out the trash, doing your dishes. You can actually pre-order one of these today for the low price of $20,000. Now, you might be thinking, this is sci-fi, I'll never own one of these, but I guarantee at least one person in this room will know someone who owns one of these robots in the next 20 years. As the demand only rises for these robots, the supply will increase, and that price will become more reasonable. And so how does all of this actually affect your portfolios? As you all know, we utilize exchange-traded funds. Exchange-traded funds track indexes. One of the most popular and well-known indexes in the world is the S&P 500. This is a list of the top S&P 500. So how many of these companies are currently investing in AI? The top 9. The top 9 largest companies in the United States are going almost all in on AI because that's how much they believe that it is the technology of the future. This is where I'd like to point out that it's different than the dot-com bubble in the sense that back in the 90s, people were buying stocks because they just had .com at the end of their name, and that was about it. Whereas with the AI bubble, so to say, the stocks that are leading the bubble are massive. These are companies with revenues over hundreds of billions of dollars a year. They have market caps over trillions of dollars, and they're not going away anytime soon. So in conclusion, in the short term, what moves the market this year was tariffs, policy decisions, and basically noise in the marketplace. In the midterm, it's the Federal Reserve policy as well as the overall state of the economy. And in the long term, innovation is what drives markets higher, and this time it's productivity gains made by AI. Thank you for your time, and now our Chief Investment Officer, Nick, is going to say.
All right, thank you, Will. So, Neo the robot, $20,000 to do your laundry. During Will's presentation, just did some back of the napkin math, and that's about 215 days staying at the DoubleTree Hotel. So, over 6 months here, where you can have housekeeping do your laundry, and still have money left over for room service. So with that, I'd like to conclude the portfolio management section of today's presentation. Let me know if you have any questions. Thank you. But seriously, don't buy the $20,000 robot. I've seen enough movies, it doesn't end well. So a quick thought experiment here before we get into our portfolio positioning. What if you could push a button and buy every single company in the world? You'd have some questions, right? Number one, how much would it cost? Number two, what would you be buying? Well, you would find that to buy the total global stock market, you'd have to shell out a whopping $133.5 trillion. And your portfolio after that would look like this. About 65% would be in US-based companies, 35% international, with a mix of sizes and styles. But as many of you know, we don't just buy the global stock market and call it a day. We do, however, use it as our benchmark to make strategic asset allocation decisions that differ from this with the goal of outperforming the global stock market. The first decision we've made and we've had on for the last decade is to overweight US exposure compared to international. Currently, we're at 20% overweight versus the global stock market is 65%, right? We're running at 85%. So let me walk you through a couple of reasons why. Number one, structural advantages in the United States. I mean, US companies, especially in tech, they are just far superior. Right, they're not just good companies, these are literally cash printing machines. NVIDIA, the largest company in the world, they're selling shovels to our generation's gold rush, right? They're making the semiconductors that produce the artificial intelligence. Number two, economic fundamentals. I mean, we are just GDP resilient, we're energy independent now. And something a lot of people take for granted, especially if you're an investor in the United States, is we have the rule of law and property rights that actually work. You can enforce contracts. Governments can't just arbitrarily decide your investments don't exist. That's important. Third, the dollar. It's still 60% of global reserves. That creates support for US assets that you don't see other places. And finally, when you look at market structure, US markets are simply deeper, more liquid, and less transactional costs than the rest of the world. So in essence, it's an extremely efficient place to deploy capital. However, with that being said, over the last 14 years, the US has done very well versus international. This year, we face some challenges to that overweight thesis. As you can see, right, Japan up, close to 30%, China 22%, emerging markets had a great year. And while the US performed well, it did lag this year versus international, again, the first time since 14 years. So what happened? Well, to start off, coming into the year, international equities were trading at about a 45% discount to US-based companies. So we started to see that valuation normalization that we talk about. Investors went into those funds, especially when US markets got volatile. Number two, along with valuation, the dollar has sunk in this year by roughly 9%, right? That creates capital flows that leave the United States. And then our Fed was late to the party in terms of cutting rates. If you look across the board with developed markets, Europe and the rest of Asia, their central banks were cutting rates far ahead of ours. That creates more risk-on environment for those asset classes. So we want to acknowledge that internationals perform well. We're certainly looking at making changes in the future. However, we're still going to maintain that US overweight. It just might be less going forward in 2026. Now, transitioning to portfolio sizing, right? We're comparing us versus the US overall market or that global market. We're currently running 75% versus the US market, 72% in large cap securities. So we're overweight by 3%. We're slightly underweight mid caps and about neutral on small cap. And they're not huge moves, but they're all intentional and for a couple of reasons. Number one, when you look at large caps, they just have these fortress-like balance sheets with extreme moats, right? There's not as much competition. Number two, earnings. At the end of the day, earnings are always justified by price. And earnings so far, as Will talked about with the AI tailwinds, they've just crushed the rest of the market. They're shelling off a ridiculous amount of cash. And then third, large caps tend to have this added benefit of acting as a volatility shield during times when things get choppy, right? Would you rather be in a $2 billion biotech company when the market's down 20% or American Express? So for those reasons, that's why we're overweight large cap. And it did well this year. Large cap comparatively versus mid and small outperformed. As you can see, it outperformed mid cap by roughly 12 points, small cap by 14 points. So that overweight in large cap did make sense. But what do we expect going forward? I think we could see some changes. There are definitely valuation concerns in large cap companies. When we talk about valuation, instead of thinking about earnings ratios or multiples, I want you to think in terms of grocery stores. And for large caps right now, we're going to use a store named Erewhon. And if you haven't heard of Erewhon, it's this West Coast company. Most of their stores are on the West Coast, right, California. But you can find strawberries there, I found out, for the wonderful price of $15. Except right now, people are obsessed with their strawberries, so they're selling for $20. Now, $15 strawberries, already very expensive, but when you're talking about $20 for strawberries, it's a little ridiculous. Eventually, investors decide that even $15 strawberries were ridiculous. And what do? Well, let me enter Aldi, or small caps. Aldi year-round, you can find strawberries for about $2.50. When they're having a sale, half off, investors or shoppers know it's a deal. So right now, investors have been shopping at Erewhon because, let's be honest, quality has been justifiable by the premiums, but you don't forget about Aldi. And here's why Aldi matters. And look at this chart. It shows the cycles of small cap versus large cap since 1999. Blue is when Aldi or small caps are outperforming large caps, and red, large caps outperforming small caps. And what you can see is over the past few years, large caps have just had a dominance over small caps, but there are times where small caps outperform. Just like international versus US, we're going through that 14-year cycle where the US outperformed, but again, it's a cycle. There will be a time, I believe in the near future, where small caps outperform large caps. And at this moment, small caps are trading at bargain basement prices. So we want to acknowledge that, and we can definitely see changes to our portfolio in 2026 with adding the small caps. So switching over to style, right? Growth, value, core. We're currently slightly overweight on value. The reason why is simple. It's risk management. So what this chart shows here is the Magnificent Seven, or the Mag 7. It's essentially the latest moniker for the best performing US-based companies. Their exposure has been something talked about this year. In the S&P 500, they represent over a third of the entire weight. Our portfolio's weight is 23.5%. So yes, we love these companies, they're incredible businesses, but when 7 stocks are that concentrated, it's only prudent to manage risk. Second is a value to it, right? As portfolio managers, we always want to have a valuation discipline. The tech-led bull market has definitely pushed those multiples higher, particularly PE ratios. And for example, Apple right here, it's trading at 33 times earnings. All that means is that investors are willing to pay $33 for every $1 of Apple's earnings, right? You start to think about the strawberries again. When does that reverse? So to compare things, our portfolio, our price to earnings ratio is at 24.5 compared to the NASDAQ and the S&P, which are much higher, right? So this value tilt reduces portfolio volatility and it gives us a cushion should market risk increase. So now I'm going to shift to the bond allocation. This has been just a tough piece for investors over the last few years. I do think we're at an inflection point, however. So when we think about bonds, there's really one reason why we want them in the portfolio. It's what we know as portfolio managers as the greatest 2 words you can hear: negative correlation, right? When stocks go down, bonds go up. And that's what this chart is showing. So historically, every year the S&P's had a down year. Bonds have returned positively. However, what we saw over the last couple of years, primarily in 2022, is that this trend has reversed course and stocks and bonds have become positively correlated. Not good. Well, what caused that? And I want you to look at this chart. What this chart is showing is originally from 1987 to 2019, bonds, just looking at the total US bond market, we annualized roughly 6% with less than 1% standard deviation, so less than 1% risk. Over the last 5 years, our annualized return on bonds is 1%. Our standard deviation is 6%. They essentially flipped, right? I mean, what was predictable became chaotic, and everything that made bonds attractive through that negative correlation, their diversification benefit, it was erased. And it turns out we are in one of the worst bond bear markets over the last 7 decades. So the culprit, well, interest rate hikes, right? The Fed. They rose interest rates at a faster pace than any other time in modern history, from 0 to 5% in 18 months. And when rates rise, we know bonds fall, right? I mean, it's just simply mechanical. If you're holding a bond that pays 2%, and all of a sudden you can get a bond that pays 5%, the bond you're holding is inherently worth less. And that's what happened, right? The Fed was raising rates because they had to stop inflation. However, it hurt bondholders, right? They took it on the chin. But the good news is that bond normalization is happening again, we believe. So that's what this chart is showing. Interest rates, like Will said, inflation, like Will said, peaked in 2022 and it was about 9%. It's much closer now to the Fed's target of 2.5%. So what we know is that we're entering a completely different environment where inflation is not as much of a concern. We believe the diversification benefit of bonds has come back and that the bear market in bonds will end in 2026. Why are we so optimistic? Well, we got a test of this in real time with the tariff volatility earlier this year. And that's what this chart shows. From February 20th to April 8th, where the market experienced a decline of roughly 18%. And that's what the red line is. If you were in an all-stock portfolio, you got hammered, down 18%. All bonds were up actually, positive 0.7. The benefit of asset allocation, as we always preach, is that it reduces the blow, right? It acts as a cushion during volatile time. The 60-40 was only down 10%. So you could save 8 percentage points in pain simply by having some bonds in your portfolio. Transitioning really quickly, something we're also very excited to talk about is we recently added a new bond fund to our portfolio. This is FBND, this is the Fidelity Total Bond Fund. Why it's exciting is that it's the first actively managed fund we've ever added to the portfolio. And I'm sure a lot of you are thinking, like, we don't do actively managed, we're all passive, track the index. However, that's with stocks. And research has shown beating the index in stocks is incredibly hard, if not impossible. The bond market is very different though. You have 4 times the amount of outstanding bonds as you do stocks. There's simply less analysts pouring over those bonds because, quite honestly, they're a little boring, right? I mean, everyone wants to be tracking what's happening in equities. And finally, they're less liquid. So this creates inefficiencies in a market, and we believe active management can actually perform positively here and do well. And so that's why we've added it. what this chart is showing to you is that institutional money thinks so as well. So this is a chart of active bond funds from 2014 to 2025, simply exploding. I mean, over 400 billion in assets now, and that number is going to continue to rise in our opinion. So the final section, what we're thinking about heading into 2026, as Will said, theme number one, it has to be AI. The AI spending is accelerating at a rate we haven't seen in a very long time. I mean, maybe since the internet. Global spend this year is $375 billion. That number is expected to reach $500 billion in 2026. And again, you look at these companies that are showing it out. These aren't tiny companies. These are the top market cap companies in the world. Meta, Amazon, Alphabet, Microsoft, shelling hundreds of billions of dollars, right? These are bet-the-company type bets that these companies are making to build out infrastructure for the next computing age. Number two, we really like international equities going forward. I mean, it's hard to argue Asia's definitely having a moment. I think that we will be adding to our international exposure in 2026, primarily in that Asia area. And then final theme, we're going to call it right here. The bond bear market that started in 2022 is dead. 3-year nightmare finished. Rates are falling, the Fed's easing, bonds are performing their actual job of diversification again. All very positive things for someone in a balanced portfolio. And I'd like to leave you all today with one of our favorite quotes. This is from Michael Porter, a really interesting guy. If you don't know who he is, I highly encourage that you look him up. However, there is a famous NBA basketball player with the same name, so you'll have to type Michael Porter-Finance. And so Michael Porter-Finance is quoted with saying, "The essence of strategy is choosing what not to do." This quote isn't just our investment philosophy. It's something we both need to follow. Us as the stewards of your capital, and you as long-term investors, right? We're not chasing performance. We're not panicking when markets get volatile. We're not abandoning our strategy because of one bad quarter or one good year. And we're certainly not going to make emotional decisions when everyone else is screaming that we should. So here's the deal. We'll keep managing your money with discipline and transparency. You keep trusting the process and not sabotaging yourself, right? Let compound returns do their work and do not get in their way. Together, choosing what not to do, that's how you win over decades. So thank you for your time, thank you for your trust, and thank you for allowing us to dedicate our professional lives to raising your financial well-being. It's a responsibility we take extremely seriously here. So with that, I'd like to end the presentation. We'll certainly stick around and answer questions one-on-one. Everyone else, have a great weekend, and please get food on the way so we don't have to take it home. Have a good day.